Step-by-step process for implementing a crypto bear call ladder in the USA. How to get minimum profit. Step 1. Regulatory compliance and platform selection. 1. Verify legality and regulation. Ensure the platform you choose is legally permitted to offer crypto options trading in the USA and is regulated by the appropriate authorities, e.g., CFTC. Many offshore platforms are not regulated in the US and carry significant risks. 2. Choose a reputable exchange. Look for platforms that offer crypto options, have a strong security track record, and good liquidity for the crypto asset you are interested in. Examples for regulated options might involve CME for Bitcoin futures options, or other US regulated crypto derivatives exchanges if they expand options offerings. 3. Account setup and funding. Open an account and complete KYC, Know Your Customer verification. Fund your account with USD or cryptocurrency as supported by the platform. Step 2. Market analysis and outlook. 1. Identify an underlying cryptocurrency. Choose a liquid cryptocurrency, like Bitcoin or Ethereum, where options are available. 2. Formulate your market outlook. The bear call ladder is generally suited for a market that you expect to stay stagnant or experience a slight decline. In this scenario, the short ITM call expires worthless, and the long calls expire worthless, allowing you to keep the initial net credit experience. A strong upward move. This is where the unlimited profit potential comes in, as the two long calls become significantly in the money. Be volatile, but with an uncertain direction. The strategy benefits from increased volatility. 3. Consider implied volatility, IV. Ideally, you want to enter this strategy when implied volatility is relatively low, as it makes the long calls cheaper, reducing your net debit or increasing your net credit. Step 3. Defining the strategy's legs, strike prices and expiration. 1. Select an expiration date. Choose an expiration date that aligns with your market outlook. Ensure all 3 call options have the same expiration date. 2. Choose strike prices. This is the most crucial part. You'll need 3 distinct strike prices. Lower strike, Sold ITM Call. This call should be in the money or very close to at the money. It generates the most premium. Middle strike, Bought ATM Call. This call should be at the money or slightly out of the money. Higher strike, Bought OTM Call. This call should be out of the money and higher than the middle strike, ratio. The standard bear call ladder is executed in a 1-1-1 ratio. Sell 1 ITM call, buy 1 ATM call, buy 1 OTM call. You can scale this up, e.g. 2 but maintain the ratio. Spread between strikes. The distance between the strikes matters for your risk-reward profile. A wider spread between the bought calls can offer more profit potential, but also increase the maximum loss range. Step 4. Calculating premiums and net credit, debit. 1. Obtain option premiums. Get the current market prices, premiums, for the chosen strike prices and expiration. 2. Calculate net premium. Net premium equals premium received from Sold ITM Call. Premium paid for Bought ATM Call. Premium paid for Bought OTM Call. If net premium is positive, it's a net credit. If negative, it's a net debit. A net credit is generally preferred for this strategy. Step 5. Placing the orders. 1. Simultaneous execution. Important. To ensure proper pricing and to lock in your strategy, it's highly recommended to place all 3 legs of the bear call ladder as a single multi-leg order, if your platform supports it. This is often called a combination order or strategy order. 2. Order type. Use limit orders to ensure you get your desired net credit or manage your net debit. Step 6. Monitoring and management. 1. Monitor the underlying asset's price. Keep a close eye on the price movement of the cryptocurrency. 2. Monitor volatility, VIGA. The bear call ladder benefits from an increase in implied volatility, especially if the price moves significantly upwards. 3. Monitor time decay, theta. Time decay generally works against the long calls, but the net effect depends on where the price is relative to your strikes. 4. Adjust or close. O. If the price moves significantly up, consider taking profits if you've reached your target. O. If the price stays stagnant or declines, you will profit the initial net credit, assuming the short call expires out of the money. O. If the price lands between your two higher strikes, ATM and OTM bought calls, this is your maximum loss zone. You may need to close the position to limit further losses. O. Approaching expiration, decide whether to close the position before expiration to avoid assignment risks or let it expire. How to get minimum profit. 1. Sell the ITM call at a deeper ITM strike. This will yield a higher premium, contributing more to your net credit. However, this also increases your risk if the price moves significantly against you and lands in the maximum loss zone. 2. Buy the ATM and OTM calls with lower premiums. This means choosing strikes that are further out of the money for the OTM call, or when implied volatility is lower, making them cheaper. Look for opportunities with a higher implied volatility for the short call and lower for the long calls, less common but ideal. This would create a more favorable net credit. 4. Short-term expiration. Generally, shorter-dated options decay faster, which can benefit the short call in the strategy. However, this also reduces the time for a large upward move if that's your profit expectation. Calculating maximum profit and loss. Example. Illustrative. Bought ATM, not financial advice. Let's assume BTC is currently trading at $60,000. You believe it might consolidate or even rise. 1. Sell 1 BTC $58,000 call at $3 premium ITM. 2. Buy 1 BTC $60,000 call CL what's $1,800 premium ATM. 3. Buy on BTC $62,000 call at $800 premium OTM. Net credit calculation $3,000, $1,800, $800 is $700 scenarios at expiration. BTC price at $58,000 or below. All options expire worthless. You keep the $700 net credit. This is your minimum profit scenario if the price moves down or stays flat. BTC price at $60,000. O. Short $58,000 call. Intrinsic value of $2,000. Loss of $2,000 from premium received. O. Long $60,000. Call. Expires worthless. Loss of $1,500 premium paid. O. Long $62,000. Call expires worthless. Loss of $800 premium paid. O net P&L $700. Initial credit $2,000. Loss on short. ETMs $1,300. This example shows that your maximum loss can occur if the price is between your sold and first bought strike, as the bought calls don't fully offset the short call's loss. 1D. BTC price at $61,000. O. Short $58,000 call. Intrinsic value of $3,000. Loss of $3,000. O long $60,000 call. Intrinsic value of $1,000. Gain of $1,000. O long $62,000 call. Expires worthless. Loss of $800. O net P&L $700. Initial credit $3,000 plus $1,000. $800 EDSOs $2,100. Approximately, this is within your max loss range. BTC price at $65,000. O. Short $58,000. Call. Intrinsic value of $7. Loss of $7. O. Long $60. Call. Intrinsic value of $5. gain of 5 cents. O long $62,000. Call intrinsic value of $3,000, gain of $3,000. O net P&L $700. Initial credit $7,000 plus $5,000 plus $3,000 equals $1,700. Profit from the upward move. The bear call ladder is an advanced strategy and requires a thorough understanding of options, Greeks, delta, gamma, theta, vega, and careful risk management. Always start with a demo account if available and manage your position size carefully. Please like, subscribe, and comment.